Okay, so it is recording now. So let's go on to. Okay. All right. So let's talk about the. So we ended on actually on page 71, I think, where we talked about the best hedge for inflation against inflation is actually tips. So that's not discussed. So maybe this tips instrument actually you can read about it on your own for your further knowledge. Because remember, U.S. market knowledge is very important because many jobs, many KPO jobs will require good in-depth knowledge of the U.S. market. So actually, the developments in the job market are actually vindicating my method of teaching, which is very U.S. markets focused because that's basically global finances. The U.S. is the most dominant market. So you don't really, you can't really study finance unless you have a U.S. markets focus. With half the instruments you will not be aware of. So make sure you read up on all this. Okay, soak up all the U.S. markets knowledge. All right. So we'll go on to, I mean, the next so we'll see anyway on page 71 what he has. Right. So he's talked about inflation, and then just run through that. So which is the end of chapter. Yeah. So the large scale inflation and the import. So it's an important problem, of course, but you don't really have a good hedge against it unless you go for tips. This is the only real hedge. Everything else is basically just yeah, there's loose statements basically. Everything else is a loose statement. The only classical hedge against and the perfect hedge against inflation is tips only, right? Only tips is a perfect hedge. But once again, read something else that I want to talk about. I was going to talk about it on a different page with respect to a different page, but let me just talk about it here, which is an important thing you need to understand. That again, this relates a little bit to economic theory as well. If you read, okay, now what is happening? If you look at so tips, as we are saying, is that it's a perfect hedge against inflation because it actually adjusts the principal. They sell it to you with a coupon, and they'll adjust the principal in proportion to the rise in the consumer price index. Now, if you remember, I had told you earlier, I think we need to discuss this topic a little bit more because as you need to understand this to understand the discussions in the market. So let that be there as a end of 710, but we will continue. Okay. So the first thing to note is that there are different measures of inflation. Now, I've discussed this point with you before. Okay, so I'll just give you, for instance, um, say, example, CPI, Consumer Price Index, WPI. Okay, sometimes we talk about Producer Price Index. So those kinds of things exist. So these different measures of inflation exist. Now, there is also so first you have to be clear about when somebody's talking about inflation is very high because you can have a situation where WPI is not moving much, but maybe consumer price index is moving a lot. Is because there are maybe some, which is quite possible to happen in India because we have a lot of, especially when you look at the vegetable supply chain, there are a lot of middlemen involved in the vegetable supply chain and the food supply chain actually. A lot of middlemen involved. So because the middlemen will come into the picture between the WPI and the CPI, yeah, especially depending on where they're located. In fact, this is also connected to a lot of your farmers agitation, because a lot of people, if you remember, one of the I forget the gentleman's name. He's a lawyer as well. He was giving a guest lecture at DSP, and he mentioned that this is not a farmers agitation; it's actually the middlemen's agitation, right? Because of the new changes that are being proposed, that'll eat into the margins of the middlemen. So you can actually have divergence between. So you should be aware that. And so the other point, so the point I will mention here is that you should be alert to have this is possible to have um, divergences between these different measures. Okay, divergences between uh, different measures of inflation. We can just repeat this. So it's actually the topic is this: the different measures of inflation. On this point of hedges against inflation, and so certain things you need to be aware of in order to understand market discussions properly, and also connect it to economic theory. The things. Have you guys studied the monetarist theory of inflation, Milton Friedman, and all that? Have you guys studied that? No? Anybody? Anybody remembers having studied the monetarist theory of inflation, which is Okay. So it is attributed mainly, one of the major monetarist economists is, and I have not discussed this with you either, right? In the past. Okay, so let me write that. Okay, so possible to have, first point to note is that it's possible to have divergences between different measures of inflation. Okay, and then there is also the other point, which is, so let's briefly mention about, now also talk about the monetarist theory of inflation. So you need to, obviously, you don't study finance in isolation from economics and law, and all these things are interconnected. Okay, accounting. So finance accounting intimately connected, and also very closely connected to economics, especially macroeconomics, but also micro, and also and of course business law as well. You have to understand company law and all these securities laws. All this is integrated, so you should always think about studying it from an integrated point of view. And now the recent situation, now there's one more discipline that is being added to the study of finance, which is inevitable, which is why, I mean, an old man like me is desperately listening to Bloomberg Technology every day, trying to keep up with what's going on, which is technology. So now you're actually studying finance. You're actually studying finance along with four additional subjects: accounting, economics, law, and technology. You have to understand this new cryptocurrency, this digital distributed ledger technology, okay, which I still don't understand at all properly, but I'm trying. So now a new discipline has come in. So the multidisciplinary study of finance. Now you have in that connection, you have to understand the monetarist theory of inflation. Okay, this is attributed to Milton Friedman. So Friedman, etc. So I'll just write Milton Friedman is the most prominent economist. Okay, maybe I spelled it wrong. Yeah. Okay. So Milton Friedman is the most prominent economist associated with the monetarist theory of inflation. So here, basically, what it says is that inflation. Later on into, we'll put it into title case later on. Inflation arises because there is too much money chasing too few goods. Okay, so you can see this classically in the pandemic situation. If you see what has happened in most countries around the world, it's pretty homogeneous, the experience around the world. One of the things that has happened is, so what we say is actually too much money chasing too few goods. Now notice one thing here, goods. This will also connect to some other point I'll make later. These are all important points which actually you'll not, this is actually my own point, but I think it's important to understand, especially from a financial markets point of view. If you're going to go into industry, you need to understand why there is some kind of discrepancy between the monetarist theory of inflation, and what is actually happening in the markets and the economy. So if you look at the monetarist theory of inflation, the classical theory is like this: that inflation arises because there's too much money chasing too few goods. So you can see here, one of the classic examples is in the pandemic. You can see that you see the pandemic. Okay, what do you have in the pandemic? You have lockdowns. So what will lockdowns do to the supply of goods? Will the supply of goods go down or go up in the lockdown? Supply of goods will go down because you're not producing. Many factories are shut down. Okay, so you have actually a double whammy here. In the pandemic, you have a lockdown. Supply of goods declines. All right. If anybody does not understand anything you hear what I'm saying, try to please ask a question. Okay. Otherwise, I'll assume that you understand what I'm saying. So you have a double whammy in the pandemic, actually, which is if you take this. Okay. You have a lockdown, you have supply of goods declines, and what are you aware that what are the central banks doing? Okay, central banks all around the world pretty much are desperately pumping money into the economy. Okay, well, let's should not use the word desperately, pumping massive amounts of money into the economy. Okay, so they're basically expanding the broad money supply. Okay, broad money definitions. Okay, so expanding the money supply. Okay, they're pumping massive amounts of money into the economy. All right, so this should actually theoretically be so this should be actually a classic, I mean, explosive case for inflation, because on the one hand, if you believe in the monetarist theory of inflation, on the one hand, there's too much. So the theory is this: that too much money is too few goods. Then, on the one hand, what you've got in the pandemic lockdown is the supply of goods declines. Okay, there are disruptions to the supply chain. Then you can see also you've seen the chip shortage, okay, which is happening. I hope you guys are aware of the chip shortage, which is affecting global industry, and even the Indian media has been talking about it. So the chip shortage basically happened partly because uh, the uh, uh, the car makers, in particular, radically reduced their orders when the pandemic hit and the lockdown came in. And then suddenly demand recovered very rapidly, and then they started placing orders. And then by that time, the chip makers had also cut down production. So now it's a big mess actually, and people are saying it will continue into 2022. So this is some of the examples of the pandemic lockdown induced disruptions to the supply chain. And generally, it's not good for the supply of goods. It's not positive for the supply of goods. The supply of goods will decline, right? So you have too few goods anyway. And then on the other side, what's happening is the central banks are pumping massive amounts of money into the economy, which is happening pretty much in every country in the world. Okay, indiscriminate monetary policy, pumping money into the economy. So basically, this will be like a double whammy, which will which should cause an increase in inflation. And you're already seeing this is what we call a double whammy, okay, which is that this is, on the one hand, supply is going down, and on the other hand, there's too much money out there. Okay, so this should cause an increase in inflation, and you're already witnessing that in the US. There is a lot of inflation happening in the US. If you look at oil prices, so I'll come back to this, but let's look at, when we talk about goods, the classical way to think about goods is actually, let's not use the futures, because we'll have to wonder about which contract to use, and we want long-term data. So if you see here, what is happening to oil prices. So since that last drop that we had when the Saudis and the Russians were fighting over the oil price, now if you see what has happened in the last, say if you just take 5 years, yeah, you can see how it's rising. It's gone to $80. So it's continuously rising. Of course, when you look at it, if you see the media reports, they're hyping it up, which is basically that prices are rising, which is actually true. There's a tremendous rise in the price level. If you think about it, from like it was zero nearly, almost at least, or say $10 or something, and now it's $80 in such a short span of time. So it is a sharp rise, but you should also remember the long-term picture. Then when you look at the long-term picture, well, you've had much worse actually. We had 147.47 is the high, I remember, intraday high in the crude oil in the West Texas Intermediate futures contract, the front month contract. So you've had levels like that. So you also have to keep your long-term perspective. But of course, this is very bad for countries like India. We are consumers, so it's very, very bad news for us. And this is partly happening because of inflationary pressure, which some of this you can understand. So this is a classic example. Okay, if you want to talk about this, because oil would fall under the classical definition of goods. Now we are coming to my next point actually, which is about the why in many cases the monetarist theory of inflation was not satisfied. Okay, we'll come to that. But first, you understand the monetarist theory of inflation, since you haven't done it, because again, in the financial markets, you'll be talking about all these things when you discuss the movements of asset prices. So so what has happened? So I hope everybody's understood this point. Basically, in this current lockdown, you have a classic case of where a classic case of the monetarist theory of inflation being kind of proved right, because on the one hand you're constricting the supply, and on the other hand you're pumping too much money into the market. Okay, so this is happening already to some extent in the US, where there are a lot of complaints about inflation, and one of the things they're talking about is oil prices. So headline inflation is going up a lot. Okay, remember I mentioned to you about the difference between headline inflation and core inflation. So there are different measures of inflation, and there is also headline and core within each measure. I'll repeat that point because you guys didn't know about that so it's the first point. So I'll reinforce that point once again. Because all these things you have to be completely fluent in when you are in the financial markets working in the industry. So you should be completely fluent with all this lingo. So not only do you have different measures of inflation, for each measure you have headline and core. Okay, so headline number and core number. Okay, the core number basically strips out the impact of food and energy prices. So in every measure of inflation, you have a headline and core. Now in this, yes, sorry, where are we here? Okay, so this is what the point I was trying to make, that you have a classic, and it's already showing up in what I was talking about is what kind of inflation are we already witnessing? That you're witnessing the rise in prices. If you look at all commodity prices, if you see here, if you look at all commodity prices here, if you look at any of this, I was just, because I'm a coffee drinker, I was just looking at coffee price. Coffee price is not so bad, but if you look at cotton prices going up, okay, pretty much everything. Okay, this one is not going up so much. Cocoa price is also going up. Lumber would be also has declined, but generally there is a lot. There is a if you look at all the other and gas prices, as you are aware, and there is, I hope you're following the news. There's a tremendous crisis in Europe because very high gas prices in the UK as well. People are sitting in the dark, so there's an energy crisis. So there's a problem of goods market inflation. So all this would be commodities. Commodities would be included in the traditional idea of goods. Okay, so this is basically already happening. So what we would say is that commodities are included in the idea of goods. Okay, when you say too much money chasing too few goods, so in the economics vision, okay, in the sphere of economics, okay, so commodities are included in the idea of goods in the sphere of economics, okay, but what is not, okay, asset prices, okay, which is asset prices, like example, say for instance, equities, okay, bonds, okay, these are not considered to be. So in economics, in traditional economics, we make a distinction between um, goods markets and asset markets. Okay, so asset prices. So let me write it: asset price, equities, and bonds, etc. Okay, are not. Okay, so in the sense, if you look at even currency prices, so if you see the price of a currency, if you look at the dollar price, okay, so the dollar index is. Let me see if we have dollar index here. Uh, Dollar index, yeah, US dollar currency index, DXY. If you look at the dollar index, so typically they would also look at this as this will have an impact on imported goods and services, etc. It's a long-term data on the US dollar index. It's like a trade-weighted index of the US dollar. Or you can look at it as something which is, we look at it as something which is related to you can also look at it from a point of view of in particular currencies. You can look at it against particular currencies also. So when you're looking at trade with a particular country, you can look at it that way as well. So here you can see the movement of currency. So the point is basically all these things, equities, bonds, currencies are not included. Okay, equities, bonds, and currencies are not included. Etc. are not. Now here's the problem. So here I'll give you a little bit of economic history. What we are talking about here is that, so first we did the different measures of inflation, that there are different measures, and then there's headline and core. Then we gave you a little bit of an introduction to the Monetarist theory of inflation. So we basically the classical language is that inflation is everywhere and always a monetary phenomenon, which arises from too much money chasing too few goods. Okay, so the money supply is really the culprit. And here you have an additional problem in the lockdown, which is the restriction of supply as well, the supply of goods. Now, the other thing now we have to understand is that in commodities, in the traditional, in the sphere of economics, when we talk about good, too much money chasing too few goods, what do they mean by goods? Well, they include the idea of commodities, okay, but they do not include the idea of asset prices. Some, for instance, stock prices, bond prices. Okay, bond prices may be rising, bond yields may be falling, as you have seen in the case of, say, the U.S. Treasury note. If you look at TNX, okay, which is, you can see here, which yeah, you can see the data here. Even though the U.S. is actually increasing the supply of its debt quite dramatically, actually interest rates are they may have risen from here to here, which is what the media will be talking about, or even here to here. The media's focus is very short term. But when you look at the long term, you can see that interest rates have been declining. Okay, and interest US 10-year interest rates are quite low. So if you're US Treasury, which is quite heavily indebted, the US government, and still they're able to borrow at 1.6% for 10 years, which is really quite a very, very low rate. So this you can see that, so all these things would not be included in the traditional economics, in the sphere of economics, these would not be included. The impact of asset prices like equities, bonds, currencies will not be included in the economics idea of goods. Okay, so now this is basically, so because in economics, what we say is that in economics, asset markets. So these things that I just showed you, equities, bonds, currencies, these are considered parts of parts of the asset market. Okay, so in economics, we have asset markets. Okay, are uh, considered different from what we call goods markets. All right, so this is one of the problems of economic theory, actually, because economic theory is typically being written by people who are academics, and they've never really operated in the financial markets. If you operate in the financial markets, you will have a greater sense that actually these are all assets. So not only are commodities, which are prominently featured in the measures of inflation. So in the headline inflation, obviously you have all these food prices. So I only showed you the soft, like if you look at, I don't know what's happening to, yeah, look at the grains. Let's see what is happening. Okay, corn, not much movement. Okay, but we don't really know the, but general upward trend you can see. Oat prices. Now look at what's happening to oats. Okay, this is the North American oats, but this is also like, this is a major component, right? Your breakfast, oatmeal. So all this is happening, and these commodities are coming into these traditional measures of inflation, CPI, WPI, etc. So what is happening is, so in economics, we make a distinction between asset markets and goods markets. So goods markets, you would have all kinds of other physical goods, and you would have all these commodities, all right, grains, then your soft commodities, okay, cotton, cocoa, orange juice, coffee, etc. So coffee prices actually also have been rising for some time. This is actually, you're just seeing the consolidation for a while. Actually, there's a long rise in coffee prices. So anyway, so this is the idea. So the other thing you have to understand is that in economics, we make a distinction between asset markets and goods markets. So in goods markets, we put things like commodities and all other kind of physical goods. And in the asset markets, we put stuff like equities, bonds, currencies, etc. Or not, currencies, etc. Okay. Now, so basically, what you have to understand, this is part of your economic history, that since the GFC, okay, so we call it the 2008 GFC, which is the global financial crisis, and since the central banks have been expanding money supply, maybe I can copy this from here. Central bank, this statement is actually true from the end of the crisis itself. Okay, so if you look at the end of the crisis itself, central banks pretty much the world over has been pumping massive amounts of money into the economy, right? We'll write it as have been. All right. Have you guys heard of QE? Does anybody know what this means? QE equals quantitative easing. You guys know what this, does anybody know? Can anyone tell me what this is? No? Okay, I hope you can hear me, right? I hope my sound, because the background is completely silent. So you can hear me, right? You understand the question? Yeah, anybody? Let me just ask someone in particular so that, 1 minute.
Yes, sir, you are audible.
Okay, I'm audible at least. Okay, that's good. Because sometimes the room is completely silent and I'm wondering whether my sound has gone off. Okay, so nobody has heard this term. Okay, now see, this means once again, it's what it's proving to me is that you guys are not doing enough extracurricular study of global finance. It includes economics, technology, everything, because this is a term that is regularly used in if you look at all these. So if you go to Bloomberg itself, there are many discussions on, there have different programs called Real Yield, talking about the bond market. Then they have Wall Street Week. They're just recapping some of the week's events. So they keep talking about these things. Okay, so you have to follow this stuff. So these are very important. Actually, it's not really acceptable for MBA students in this day and age to be graduating without understanding stuff like basic stuff like quantitative easing. The quantitative easing, how do I write it later? Maybe I'll try to find a link later on which explains properly. But I can explain it
So
to you.
it's
So
a
yeah, go ahead.
so it's
Go
a
ahead.
tool that's used. So I think we have read about it. It's a tool that is used to expand or to pump in money in the economy, whereby the government or the central bank, I think they buy bonds. Is
Okay,
it that?
good. Yeah. So you're right. Okay, so now if I ask you a counter question, do they buy bonds on an outright basis or do they buy bonds through repos? You guys understand repos? Does everybody, you understand? This is Soumya, right?
Yes, sir.
Okay, so do you understand? Let me ask you since you're answering. So your question is correct, but it needs to be improved a little. Your answer is correct, but it needs to be improved improved a little bit. Which is you're right that pump mass. So we can copy this and keep some of it. Okay, pump. Maybe we don't need to write this. Let's just write down what you've said. Okay, you're right. So my counter question now to probe a little further. Pump a massive. We don't have to write massive amounts. Pump money into the economy by buying bonds. Okay, so this is what Soumya said. Okay, by buying bonds. Now my counter question to you. So now I will find out whether you understand repos also, because actually this is my first time teaching you. So this is and since this time I've tried to follow the textbook, so I have not gone according to my own syllabus. But anyway, so there are certain basic stuff. I mean, so the reason I'm discussing all this stuff is that as a participant in financial markets, as somebody working in the industry, and everything, pretty much every finance job that an MBA is going to have is going to be heavily centered on financial markets. Even if you're working in the corporate finance department I mean, that's why I teach you from a very heavily sort of financial markets focused point of view. But as you can see, we are delving into different subjects like economics, a little bit of technology, a little bit of law, and accounting, of course, as well, right? So coming back to Soumya's answer, my counter question to her. So what she has said is she's not wrong. What she has said. Now I just want to make her answer sharper by defining what it is not. So what she has described is correct. That this is what quantitative easing, pumping money into the economy by buying bonds. Okay, central banks. Okay, so we have to mention that central banks. So quantitative easing is also known as QE. Okay, QE. So you should understand the joke as well. So there's a very famous ocean liner called. So the Federal Reserve did several rounds of QE. So the second round of QE was called QE2. So I'll just write it like this. So QE2 is actually they were calling it QE2, the second round of quantitative easing. And actually QE2, if some of you may be aware, is a very famous ocean liner. It's named after Queen Elizabeth II. So it's a massive ocean liner. It keeps going between US and UK and maybe other places as well. So there was a joke basically that this is QE2. So they were punning about making a reference to the ocean liner. Okay, never mind. So all this also you should understand. So central banks pumping money into the economy by buying bonds. This answer is correct. Now my counter question to Soumya is, are they buying bonds on an outright basis or buying bonds through repos? Is my question clear? Let me
So I
write this
don't
question.
understand the difference between.
Okay. Okay, so you're right. Okay, so let me explain that. Let me have to explain that as well. Because you guys have heard of open market operations. You heard central banks
Yes,
doing
sir.
open. Okay, so how do they do open market operations? Can you explain? How do they do open market operations? So we are talking about, my question is, it's correct, okay? Central banks pump money into the economy by buying bonds, okay? Why is it called quantitative easing? Because the basically quantity of money is increased, okay? So there is a easing, okay? Quantity of, actually it's not in, is increased. The quantity of money is increased. Okay, the quantity of money is increased. Hence, an increase means there is a sort of facilitation or there is a relaxation. Okay, so in that sense, we say easing. So the word easing is basically the money supply is kind of being relaxed. Or the central bank's hold on the money supply is being relaxed, or they're kind of loosening their hold, they're tightening. So therefore it's easing. Okay, so quantity of money. So this quantitative comes from the quantity of money. The quantitative of meaning. So understand why the term exists before I'll come back to the question about repos. Okay. So first let's explain the term. So Shamya is correct. The central banks pump money into the economy by buying bonds. Okay. So and so this quantitative easing term comes from the quantitative comes from the quantity of money which is being increased. Okay. The quantity of money in circulation in the economy is increased, right? So now, but why is it called quantitative easing? Okay, because basically interest rates, as you know, many central banks, including our own, they target the interest rate, right? Okay, so interest rates, which is let's say a traditional policy target, okay, a traditional target of central bank policy. So all this stuff which I'm writing, if anybody does not understand, you have to ask me, okay? Don't just switch off, because these are all things you need to understand. So these are all basic, what I would call, like if I had to teach a course called the macroeconomics of financial markets. So there's a connection between macroeconomics and financial markets. All these things are included in that course. Okay. So so these are all central ideas for anyone operating in financial markets. So interest rates, which is a traditional target. So why quantitative easing? So basically the idea, what they're trying to convey with this term, quantitative easing, is that so normally when as you are aware, normally when central banks decrease interest rates, right? We say that the central bank is easing, right? And when they increase interest rates, we say the central bank is tightening, right? So this term comes from that kind of context, because traditionally most central banks today target interest rates. Like you have a policy rate, okay? So traditional target of central bank monetary policy. That's why in most countries you have this thing called the policy rate. In India, we use that term for the repo rate, okay? Policy rate. If you go to the Eurozone, the ECB also, if you look at their website, will have a policy rate number, okay, which actually currently is negative. So, so all these, the policy rate, you'll see even in Japan, you can use that term. It's a commonly used term, the traditional target of monetary policy. So we have this common term that is used around the world, which is what is the policy rate? You go to any country, go to Denmark, and you ask, what is the policy rate in this country? That means people understand that you're talking about the rate at which the commercial banks will borrow reserve funds from the central bank. So this is basically the common connotation of the word policy, of the term policy rate around the world. Now, traditional, but interest rates, the traditional target of central bank monetary policy, okay, are not touched. Okay, not touched. Why not touched? Okay, let's understand this the full context of quantitative easing. Okay, which is why not touched. Okay, they are not touched. Okay, so in this case, why do we say quantitative easing? Is this normally because, so understand the whole term, that normally when central bank, because the traditional target of central bank policy, monetary policy in most countries is interest rates. So we have a policy rate in most countries, and the central bank tries to tighten or relax the supply of basically the monetary accommodation. The supply of money. They try to tighten or loosen the supply of money by targeting interest rates. That's how they typically operate. Now, but in this case of quantitative easing, what they're trying to indicate, the easing word indicates that they are also easing in this particular case. In the case of quantitative easing, they're also easing, but they're not easing through the traditional route of reducing the monetary policy, the policy rate. Okay, so that easing will normally be done through this, but they're not doing it in this case like this, but they are doing it by increasing the quantity of money in circulation in the economy. Okay, so this is basically why this term is written the way it is. It's quantitative easing. So it is easing, yes, but not in the way that you traditionally understand it, because normally we say if the Bank of Japan is easing, you would typically understand that the Bank of Japan has cut its policy rate, but it's not that kind of easing. It's actually quantitative easing, because you are increasing the quantity of money in circulation in the economy, okay? And as Soumya pointed out, this is done by buying bonds. Okay, so this is the first. Now you understand the context of the term quantitative easing. Why is it called quantitative easing? Right. So now you have a sense of it. Okay. So now we come to another question, which is the question that might arise in your mind is, so why are they not following the traditional method? Why are they not touching the interest rates? Why are they not touching interest rates? Right? Why are they not touched? Okay. Why? So why are interest rates not touched? Okay. Or why not touched? That's right. Let's ask this question. Okay. Why not touched? Because if you see, then already your why not touched? Okay. Because basically, QE is done in most cases. If you see where the the situation is like here, if we see anything here, we have in terms of FRED. Yeah, we have this categories of data in the FRED, right? So if you see essentially here, the reason then this will let you see the what I'm talking about. So the short answer is, why are we not touching it? Because these. Let me just go back here. Okay, why not touched? Okay, cause QE. Now let's have a look at this first. Okay, let's look at interest rates, and hopefully we can just find it here. Effective federal funds is what I'm looking at. Yeah, let's look at Fed funds, and let's look at federal. Yeah, this is what we're looking at. Okay, so you can see this is the policy rate in the U.S. Okay, which is effective. So when they say that, I hope you guys are following all that, right? That because just a few weeks ago, I think just not even a few weeks ago, just a few days ago, I'm kind of losing my sense of time sometimes because I have so much workload. But not too long ago, we had another meeting of the Federal Reserve. I think just less than 2 weeks ago, and where the federal funds, where the Fed made certain statements and there was a market reaction. So you guys have to follow up these FOMC meetings, okay, and what they say. You have to get the hang of these things, okay. So as you can see here, this is basically updated. So let's look at the monthly series, okay, and see here. Hopefully here, federal funds effective rate. Now you'll understand why not targeted. Okay. Now you see here, so typically, so you see this is called the effective federal funds rate. I'll put a link to this here straight away where you can understand. Okay, now why not touched? Okay, so let's just put this link over here. Fed funds. Okay, this is so you also have to understand, as I said, your knowledge of the US markets must be very solid. So this is an important part of understanding US monetary policy. When the Federal Reserve is meeting, when the FOMC meetings are happening, they are actually talking about what should be the new target range for this rate. So they usually set a target range. So the current rate is 0 to 25%, 0 to 25 basis points. Okay, that's why you see the current rate is 0.08. So this effective federal funds, you can read about the definition over here. Okay, this is basically this is a rate which is calculated based on actual borrowing transactions. So there's a typical lag. So it's based on actual interbank borrowing transactions between commercial banks. But in the market for reserve funds is, you guys understand that in the fractional reserve banking system that most of us have. Okay, I hope you guys understand all these terms, right? Fractional reserve banking system, reserve funds, right? Fractional reserve banking means that what? Anybody can tell me what fractional reserve banking mean? No? I'm putting all these keywords here. You better find out all this stuff, okay? If I don't have time, I'll explain it briefly. This is all totally unacceptable. You have to understand all these things. These are basic macroeconomics. India has a fractional reserve banking system. What is all this CRR, SLR? What is all this stuff? Okay. Most countries don't have SLR, but most countries have CRR. Okay. That fractional reserve banking simply means that if you get $100 worth of deposits, you cannot lend the full $100 out. Okay, as you know, commercial banks are basically the business of taking deposits and making loans. But if you get $100 worth of deposits in a fractional reserve banking system, Well, obviously, what they've not mentioned here is that it should be generally a positive fraction in the way we describe it. It should be a positive fraction. It's not as, I mean, technically, zero can also be a fraction. Okay, but if you put zero in the numerator, it is also, it's a technically, mathematically, it's a fraction, but that's not what we understand by fraction, actually. We mean something greater than zero. So here you have CRR, SLR, etc. What is all this? Basically, these are your reserve requirements, right? And so SLR would not be part of reserve funds. The SLR is a peculiarly Indian phenomenon, and CRR is common to most countries in the world. Okay, this cash reserve requirement. You'll see recently the People's Bank of China has been relaxing the CRR percentage. They've been lowering the CRR percentage because they want to promote economic growth. So fractional reserve banking system means just the system you already know in India, which many countries have, that you can't lend, if you get $100 worth of deposits, you can't lend out $100. You can't give out $100 in loans. There's some number, okay, maybe 10%, 12%, 13%, something like that, which you have to keep, or maybe 6%, whatever that number will be fixed by the central bank. And that will be fixed by the central bank, generally as CRR, which most countries have. SLR is not too many countries have. And those amounts have to be maintained with the central bank, with your account with the central bank, in your account with the central bank. So if you get $100 worth of deposit and CRR is 12%, so you got to keep $12 in your account with the central bank, and that has to remain there. So you can't use that. On the back of that, you can't lend that $12 out. So that's what fractional reserve banking system means. So you have to understand all these things. So when we say what is the market for reserve funds, another all this, these are all technical terms. You guys have to understand all this stuff. I'm just surprised that you guys don't know any of this stuff. That means actually that, oh, okay. So see, I'm just, I was going to write market for reserve funds, and because I'm surprised, I'm writing the SUR for surprise. Okay, the market for reserve funds. You got to know all these terms. This is market for reserve funds. Okay, that actually, you know what this is? This is basically the traditional. If you look at the business school syllabus around the world, I mean, especially in India, at least India, I'm familiar with more. The material that we are teaching is basically the same stuff we were also taught in IIM Ahmedabad, and a lot of the material is actually not relevant for operating in the financial markets. So these kinds of things which you really need to know, that's not part of the syllabus in most, because it's not covered in most of the textbooks, and it's not part of the syllabus. But it's actually, we don't have time to teach all these things to the students because there's so much, practically oriented theory that needs to be taught. Right now, the syllabus in most of the business schools, if you look at, it's pretty much the same syllabus. Okay, and it's not really very oriented towards to what you need to, what kind of knowledge you need to operate in industry. But anyway, so this is also another term you need to understand. Market for reserve funds. What is it? And you'll have the video available, so I'm not going to write down everything. This is your market for, this is the price. The federal funds effective rate is the, of course, it's a weighted average. So if you did not have a weighted average, you just look at the price at any point of time, which is here. This is basically the price, market price, in the market for reserve funds in the US. So reserve funds is nothing but this business. The fractional reserve banking system requires certain reserve requirements. Okay, basically, write it here a little bit. Okay, this is CRR, SLR is given to you just to give a Indian example. So fractional reserve banking system generally imposes. Now again, why am I saying generally? Because in the US you have a very peculiar system right now. Generally imposes non-zero, okay, non-zero, or let me not write non-zero, that is not correct, okay, positive percentages of English construction is not very good, the sentence construction, but we'll see if, but you understand what I'm saying, okay? Then because I'm writing it, also it imposes positive percentages of their, let me, if I put it in brackets, then it'll be a little better in terms of construction, of their net demand and time deposit liabilities. Okay, if you go into the Treasury Department of any commercial bank in India and you go and sit on the money market desk, you will see net demand and time deposit liabilities. I'm using some Indian language here, but most countries will have similar kind of ideas. The ideas are exactly the same actually. They may use slightly different terms. Okay, or there is a term which you'll hear on money market desks in treasury departments of commercial banks in India. That's called NDTL. What is NDTL? NDTL is net demand and time deposit liability. So the central bank will calculate, let's say you have HDFC Bank. So let's say they have, in the last fortnight, HDFC Bank had like net demand and time deposit liabilities of say 15,000 crores, whatever it is. Okay, so on that 15,000 crores, maybe they have to maintain. Let's say, assume the CRR is say 8%. Okay, so they have to maintain that 8% of that 50,000 crores for the next fortnight. So first we'll see what they had in the last fortnight. Okay, and then they'll have to maintain the average daily balance in the central bank of CRR of 8%. Or the 15,000 crores is what they had in their previous week, in their previous fortnight, of net demand and time deposit liability. Demand deposit means savings accounts. Time deposits means all those fixed deposits we put up. Okay, all those are going to be added, and then you net out any other kind of borrowings and stuff like that which you may have. So these kinds of deposit liabilities here, which you take these deposit liabilities, and against that you you impose a certain CRR requirement, whatever it is, say 8%. So 8% of 15,000 crores, they will have to now maintain for the next coming fortnight. So there is a lag here, because the lag allows you to calculate the requirement properly. Because if you have to maintain it in real time, you don't really know what's going on with the NDTL balance. So this is how the fractional reserve banking system works, and the treasury departments of the commercial banks, part of their job on the money market desk is to take care of this problem. This is a statutory requirement, and so the money market in India will also be taking care of the SLR, which is the statute. What is the full form of SLR? Anybody?
Statutory liquidity ratio.
Yeah, right. So this needs to be invested in what we call GSECs, that is government securities, right? So this will basically be invested in government. That's also taken care of by money market desk. Okay, so this is what's happening. Okay, it's a positive percentage of the net demand and time liabilities, or NDTL. Okay, so fractional reserve banking system generally imposes positive percentage. Let's call this the other term that I want to use, which you need to understand: reserve requirements. So this we can put in bold. Reserve requirements is a technical term. Fractional reserve banking system. So everything you need to know conceptually is all in bold. Okay, so you have we can put all this different measures of this stuff. You also need to understand CPI. Okay, then you have the monetarist theory of inflation. And then you have asset markets are different from goods markets. Okay, this is important from an economics point of view. In economics, okay, then you have quantitative easing. This is also something we need to understand. Quantitative easing. Then policy rate. You need to understand what a policy rate is. In India, it's the repo rate. So in the US, this is the policy rate, effective federal funds. Okay. Now, why not touch? I'll come to that. But before that, I wanted to just, as I was describing the market, the Fed funds rate. Okay, the effective Fed funds is just a weighted average of the actual borrowings that happened the previous day. So this is the market. So in order to understand what the Fed funds rate is, you have to understand this. That's why I went into this. You may wonder why I'm going further and further away from the question I asked Soumya, which is, are they buying bonds outright, or are they buying bonds through repos? Are they buying bonds through repos? Now, why did I move? Because I had to make sure that first you understand all these terms. Right? So to understand the Fed funds rate, you have to understand what is fractional reserve banking, which is basically to understand any policy rate anywhere in the world, which is basically the market for, you have fractional reserve banking system that imposes reserve requirements. Now you understand what reserve requirements are. So CRR is an example. So actually you already knew most of you know what CRR is. Soumya has answered the SLR part. Now, you know all this, but you just don't know these technical terms. But that's not acceptable, because as a finance student going out, graduating as an MBA finance, you have to know these things, right? So fractional reserve bank imposes reserve requirements. NDTL also you should understand. Okay? Understand, figure out how it's calculated. Then you have this is known as the market for reserve funds, basically. So you can say the market for reserve fund. Now this is also a technical term actually. Reserve funds in the commercial banking world, around the world, everyone, if you go to the US and ask what is reserve fund, it's the same concept. India, US, Japan, everywhere, it's the same. The market for reserve funds is where commercial banks borrow from each other. This is the interbank borrow from each other to fulfill their reserve requirements. Okay, so basically, obviously, some banks will be surplus, because they may not have made enough loans, so they have lots of excess reserves lying. I mean, if you look at their deposits, maybe they have $100 worth of deposit, and maybe the CRR is say 12%, but they have $100 worth of deposits, but they have maybe like $35 lying in their the account with the central bank. Okay, so every commercial bank has an account with the central bank, so they have $35 lying in the account with the central bank, but their actual requirement is only $12 because the CRR is 12%, and so they have $100 worth of deposits. So that extra amount that they have, that $23 extra that they can lend that out in the interbank money market, which is basically the interbank money market, which is the market for reserve funds. The interbank money market actually deals with other instruments as well. It's a broader term. Interbank money market deals with all kinds of other trading that banks do in the money markets. But one of the important functions of the interbank money market is which interbank means between commercial banks. Okay, so the treasury departments are involved in the commercial banks in participating in the interbank money market. So one of the important functions of the interbank money market is to allow banks to borrow from each other. Okay, borrow from, or actually some are lending also, or borrow from, lend to. Okay, to allow is where commercial banks borrow from, lend to each other. Why are they doing it? Because the objective is to fulfill their reserve requirements. So those banks which are kind of running low on their reserves and their account balances at the central bank, maybe HDFC Bank is required to keep like say $12 of reserves. Maybe they're actually their reserve balance has run down to $9, so they need to quickly borrow $3 from someone. So they'll contact Canara Bank in the interbank market, and Canara Bank maybe has some excess funds lying in their central bank account. So they will lend the money to HDFC Bank, and there'll be some period attached to it. They may borrow for overnight, they may borrow for 14 days or whatever, right? So it's a money market desk which has to take the call on all these things. So this is basically what is the market for reserve funds. Actually, the whole, yeah, go ahead.
So if banks borrow from each other
Yeah.
for these reserve requirements,
Yeah.
don't you think the entire purpose of reserve requirements stands defeated then?
No, it's always see. Basically, what this allows is I understand what you're saying. That actually, what you seem to be saying is that if they are short of reserve. So if you go back to this example of HDFC Bank, which I said, HDFC Bank is required to keep a reserve based on what they had NDTL they had last fortnight. They are supposed to keep an average of $12 in say the CRR is 12%. So they are required to keep an daily average of $12 in their account with the central bank. Okay, positive balance. Now, what you're saying, but as we said in the example, that their balance has actually gone down to $9. Okay, so what you're actually suggesting, if I understand you correctly, is that why has the balance gone down? Because they have lent too much money relative to what they had in terms of deposits. They have basically created too many assets, the loan assets. The relationship managers have been overactive and they've made too many loans. So what you're suggesting, if I understand you correctly, is that HDFC Bank should be required to call in those loans. That is basically call up those borrowers and say, sorry, Shivangi, we lent you money, but you need to give it back to us because our reserve requirements are running short. Am I correct? Is that what you were trying to suggest? That
No,
basically
so I'm
the bank
saying
should be required to cut back on lending. Yeah.
Yeah, not necessarily call it halfway through the loan period, but be wary of it proactively and not to lend that money in the first place, so that they have
Okay.
enough cushion available to uh, for the reserve requirements.
Yeah. Okay. So that's a sensible that's sensible advice. So generally, banks will try to do that, but you have to understand that in the banking business, there is a tussle between one is that compliance element of that, but also you have to understand that banks make money when they make loans. So they have an incentive to overlend. Okay, so this is why this happens, that you can't exactly predict what will happen, and it's difficult to coordinate as well properly between the deposit liabilities, the team that is organizing this NDTL, and taking care of getting deposits from various customers, and on the wholesale side as well, the corporate bank is desperately trying to lend because every company wants to do wants to increase their sales. So for a commercial bank, you have to understand that sales is loans, right? So the enterprise is they're totally geared to making loans. Of course, you do credit analysis, like one of your seniors is working with Standard Chartered now, Rajan Sukija. So he's a credit analyst. Okay, so Rajan's job is to basically, so the relationship managers want to lend to everybody. They want to just lend to everybody because their appraisal will look good because they have made so many loans. But it's the job of the credit risk analyst to decline certain applications because the financial conditions of the company are not so good. So in that way, so part of the reasons what you're saying is sensible, actually, sensible advice, but in practice it doesn't happen because you have to understand that the whole beast, the commercial bank beast, is totally oriented towards making loans because that's their business. Okay, just like you go to Oracle, the whole spirit, or any kind of software company, the whole spirit of the company is everybody's trying to push sales because that's the heart of every business, right? So that's why this loan thing happened. So you can't match it. So what it basically what it does is it puts compliance pressure on each of the bank, this reserve requirement system, and make sure that they at least have the reserve funds in their account to back up the loans to back up basically the deposits that they have taken, right? So that this is basically to ensure that there is a certain amount at a bank level, because see, basically what happens is that if you don't, let's say Canara Bank has $35 of excess reserves, okay, or so I said $23 of excess reserves. Now, because if you don't keep track of it, because the central bank does not want to keep track on a system-wide basis for the reserve requirements, so they want to basically impose this requirement on each commercial bank and ensure that each bank is adhering to the reserve requirement so that whatever deposit liabilities you had in the previous fortnight, you are at least in compliance with the reserve requirement in the next fortnight. So it imposes the requirement on the bank because if it does not track that HDFC has the minimum balance, the central bank does not basically want to be in the business of tracking whether Canara has an excess balance, and Canara's excess balance is making up for HDFC's shortfall. So that they don't want to do, and it's a little bit messier also to do that on a system-wide basis. So this is why the system is designed in this way, to ensure that the banks are in compliance, okay, with the basically also this will also act as a check on credit. So there's also not it's not that it's not acting as a check on credit creation, it is also acting as a check on credit creation, but on a slightly lagged basis, right? Yeah. Does that clarify your question?
Yes,
Your doubts a little bit. Yeah. So
yes.
this
So,
is how
so,
the
so
system
central
works.
bank is averaging it out, right? If one
Yeah.
bank does not necessarily does it, then somebody or other bank would do it on their behalf, and overall they're managing it at a macro level.
No, 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 no. That's not what's happening actually, because it's the responsibility of every bank. That's why you have the interbank market for reserve funds. So HDFC has to be compliant, Canada has to be compliant, Bank of Baroda has to be compliant, Citibank has to be compliant. Each bank has to be compliant on their own for their own NDTL figures. Okay, so every bank will have a different NDTL figure for the previous fortnight, and each bank has to be in compliance. So it's actually not the macro level; it's actually at the micro level of each bank. The central bank imposes these requirements at a micro level, and that's why you have a market for reserve funds. Okay, which is why, because every bank is desperately scrambling to, if they find that, like, compared to what their NTTL was in the previous fortnight, in this fortnight, they are now, their RMs have made so many loans that basically their balance with the central bank is running low, right? You understand that when you make a loan, okay, so if we make a loan, if I give a loan to, if I'm a commercial bank, I give a loan to Rohan, what it does is basically, so I just maybe create, say, Rohan's company, I create a current account and I just credit his account for his, give him the funds. So immediately what he'll do is he'll write a check on that account and he'll take the money out because his banker is probably maybe HSBC. So he'll write a check and then he will somebody will present that person, or maybe also has an account with HSBC. They'll present the check and then eventually the money will get drained from my account with the central bank. So my reserve funds balance is going to go down. Okay, so that's how the loan business works, because you give a loan to somebody and they will immediately write a check against that credit limit. Okay, or they'll just move the funds out and it will go to the reserve fund account of some other bank where they are banking. So it goes out of your account. So this is basically meant to make sure that on a lag basis, each commercial bank is not lending more money than would be allowed by the CRR requirement for that week. Okay, and even if they are lending, then let them borrow even if they have basically given the money out as a loan, then let them make it up by borrowing the excess reserves from other banks. Are you following? It's just that, of course,
Yes,
they could do it
good.
they could do it as a macro level as well. You're right about that. They can do it as a macro level as well. But this is not how the system has been operating in most countries around the world. They are choosing to do it as a micro level, which means each bank has to be compliant for themselves. So if HDFC's NDTL previous fortnight was 15,000 crores, then on a lag basis, in this fortnight, the money market desk, precisely what will happen is that inside the HDFC Bank Treasury, the money market desk will already have this number in their head, that 15,000 crores and whatever the CRR is, let's say it's 12%. So 12% of 15,000 crores we have to maintain as, hey, let's assume the SLR is zero. Okay, then 12,000 for of the 12% of the 15,000 crores of the NDTL we had last fortnight. This time we have to maintain for the coming fortnight, every day, average daily balance of our account with RBI has to remain at minimum of 12% of 15,000 crores. Average daily balance. So if you are short on a particular day, if you go down to maybe say 9% on a particular day, you still have another 13 days in the fortnight. Then you can go over for the next 13 days, right? You borrow a little extra, and then you go take your balance to maybe 18 or something. When instead of 12, you take it up to 18%. And in that way, you can make sure that you, on an average basis, weighted average basis for this current fortnight, your daily average balance comes out to be over the 12% limit. Is this clear? Yeah?
Yes, sir.
Okay, so
Yes.
everyone, I hope, has understood. And the video is available. You can actually play it back. So please understand all these things, how they work, okay? This is the heart of the macroeconomics of what I call macroeconomics of financial markets. It's intimately connected to market macroeconomics. You would have studied all this stuff in macroeconomics, fractional reserve banking. So, but you need to be aware of the technical terms. Remember, you cannot go because you are going to be graduating as finance students, finance MBAs. So you cannot talk like a Ola driver. You have to talk in the language of finance, which means you have to use the technical terms and you have to understand exactly what those terms mean, right? So this is the important part here. So you understand all these things. So what is this? Basically, this effective federal fund. This is just the price, because every market there's a price. In Gazipur market for potatoes, there is a price in that market. Here also, there is a price for the reserve funds. Okay, this is the market for reserve funds, and this is the price in the market for reserve funds. Now we were talking about why. And so this is normally what the federal funds will with what the FOMC, which is Federal Open Market Committee, will target. This is the target of US monetary policy. Okay? They are targeting the interest rate. So when they want to relax policy, they would typically lower the interest rate. And when they want to tighten policy, they would raise the interest rate. Okay? This is how it works. So in the days of it, in the 70s, you had very high inflation running up. So you had a guy called Walt Volcker, who was chairman of the Fed at that time, and for a big chunk of that period. And he actually started tightening interest rates to basically control inflation. There was very high inflation in those days. So now we come to this. This is the policy rate, okay, which is the effective federal funds rate, which is policy rate is nothing but basically what is the interbank. This is an interbank rate, which is the market in the interbank rate for the market for reserve funds, right? So in the market for reserve funds, this is where the banks are actually desperately borrowing from each other, those guys who are short, to make sure that their own account balance with the central bank, the commercial bank's own account balance with the central bank, is at least at the minimum level required by the reserve requirements and the figures that they have for NDTL in the previous period. Every country has a similar system. They are all using lagged methods. That previous fortnight, maybe not fortnight, maybe month, some previous period. Then on a lagged basis, in this upcoming fortnight or month, whatever the period is, you try to maintain the reserve requirements relative to the previous fortnight's NDTL. Right? So this basically creates a activity in the interbank market for reserve funds, where banks who are surplus reserves are lending to banks who have deficit reserve, who have deficits in their reserves. Right? This is basically the system. Okay, so now you understand. Now I was coming to the question is why is the question where we went into this long discussion is I said that quantitative easing is easing, yes, but not in the way you normally understand it, because normal easing is by reducing the policy rate, which the People's Bank of China recently did. Oh, sorry, the People's Bank of China was actually recently what they did was they lowered reserve requirements. Okay, sorry about that. So, but this is how it's normally done. You reduce the policy rate. One of the ways it's normally done, the main way. But here in quantitative easing, the policy rate is not touched. We actually pump money into the economy by buying bonds. How does that happen? When the central bank buys bonds, the central bank has to sell something, because every transaction is an exchange, right? So if I'm buying, close-up toothpaste, I'm buying close-up toothpaste, but I'm selling cash. I'm selling Indian rupees, right, in return. So everything is an exchange, right? So when you're buying bonds, you have to be selling something. And what is it you're selling? You're selling money, right? So they're buying bonds from commercial banks, the central banks, and to the commercial banks, they're selling money, which means they're basically topping up the accounts of the commercial banks at the central bank. So if the RBI is buying bonds from many banks, let's say one of the banks is Canara Bank, what the transaction will be that RBI will take the bonds from Canara Bank, and in return, RBI will credit Canara Bank's account with the Reserve Bank, okay, with RBI. So now Canara Bank's reserve position, whatever it was, has now gone up, right? And then against that excess reserve, we're assuming that Canara was compliant in the beginning. Then against those excess reserves, now Canara can go and make more loans. Are you following the logic, right? So they buy bonds, they increase the supply of money, which basically means that the reserve accounts of the commercial banks with the central bank are increased, because that's how the central bank pays for its bond purchases. It's buying bonds and it is crediting Canara's account with RBI. So Canara now has excess reserves, and against this excess reserves they can make some loans, right? So that's and then basically this scheme is supposed to increase the supply of credit. Now, coming back to this question, so this is how the system works. Okay, that when you say, in case somebody did not understand what Soumya meant by saying that they are pumping money into the economy by buying bonds, so I just explained this transaction also in detail to exactly show you why this kind of action will lead to an increase in the supply of money, because it will lead to an increase in the reserve account balances of the commercial banks from whom the RBI, the central bank, is buying bonds. Right. Now, coming back to my earlier question, is that the policy rate is normally not touched. You're not easing by doing reduction of the policy rate, but you're easing by doing quantitative expansion of the money supply. Okay? There is a different way of doing easing. Now, why is that done? Why is this policy rate not touched? Now you understand when you look at it here. Okay, I'm just going a little bit slowly, but I'm going in baby steps, repeating the same thing many times, because I want to make sure that everybody understands when you play it back later on. Okay, now look at this in this situation after the 2008 crisis. Okay, the 2008 crisis, as I told you, the central banks desperately reduced the interest rate down to near zero. All right, and only this when after after Trump came to power and the economy started to expand, then they initially raised rates once before Trump got in, But then during the Trump years, they actually rapidly raised interest rates once. And again, of course, they started lowering before even Trump left office. And then, of course, during the pandemic, they're back to zero. Now, you see the problem here when interest rates, so this QE business started, this never happened. This QE never happened over here. It only happened after the GFC crisis. Now, imagine where your interest rates are already at this level. Can you cut interest rates any further? Obviously, you can see that this is your policy rate. It is already near zero. So normally you reduce policy, you do monetary easing by cutting the policy rate. But your problem is your policy rate is already here. So what are you going to cut? It's already at zero. So that's why they came up with QE. And the problem was that even though the policy rate was at near zero, there was no impact on the economy. I mean, the economy was still not responding in a positive way. It's like you give somebody, keep on giving them antibiotics, but there's no response, they're not getting better. So the economy, even though interest rates were kept at zero so you see how long it stayed at zero, December 2008, pretty much near zero. It started rising only in early 2016 a little bit, okay? And then later on in November 2016, after Trump came to power, then they started really raising it up. So at this level, you can't cut interest rates anymore, but at the same time, the economy is not responding. The economy is still kind of half dead. So you're so desperate as a central bank that you're trying to do something. And what can you do? You're thinking about what can you do additionally to enable the economy to grow. Of course, these buffoons don't understand that the reason the economy is not moving is not because of interest rates being too high or lack of money supply or anything, because most of these countries have stupid policies. They have they have excessive regulation, they have high tax rates, and they have excessive government intervention in the economy. And that's why maybe there's just a little bit of an economic shock, and it will take time. Eventually, the market will come back. But by doing all these kinds of artificial interventions, this is not the way that interest rates should be. It's not proper for interest rates to be artificially at zero. This is also not a healthy sign. So this is why, so because this is the situation, you can't cut rates anymore. I'm answering this question of why are policy rates not touched. So desperately, they're trying to think of something else to do. So they came up with this idea of quantitative easing, which is basically pumping money into the economy by buying bonds, okay? Which is now, when you buy bonds, obviously the quantity of money. Now coming back to my question to Soumya, the counter question, okay, which is, I'll put that counter question here. Okay, I'll put that counter question was here. I'll put it here because I think we are nearing the end of today's class. I will not be able to answer that here, but I'll put the question down here. Yeah, that was the question that I was going to ask. Okay, let me repeat the answer that she said, the answer that she gave, and then I'll put it here. I'll just take this and put it in. I'll just put it here. Just take 2 minutes. I'll just take not even 2 minutes actually. I just want to make sure that we set up, because you need to understand repos also. I mean, it's not acceptable for a finance professional not to understand repos. I guess nobody understands repos right now. Okay, so 1 minute. All right, so the question that I'll just write down, okay, I'll just quote this, what Soumya said, okay, is QE. Okay, now then I'll put are they buying bonds outright, or I'll just make this note so that I don't forget. Are they buying bonds? Now that will help you to understand the difference between buying bonds outright and buying bonds through repos. Are they buying bonds? This is a technical term, outright. Okay, or are they buying bonds through repos? So once we do this, are they buying bonds through or as part of repo? That would be better than through actually. Are they buying bonds as part of repos? That's another technical term. All right. So you need to understand both outright and versus buying bonds outright or buying bonds through repos. Buying bonds as part of repo. This is what you need to understand. There's many textbooks actually. Many textbooks you will find that they write in such a way that they kind of, if you see open market operations, now this is where open market operations come in. Okay, all these open markets operations are actually done through repos, but it's not explained very well. Sometimes you'll find statements in books which are saying they're buying bonds, or they're buying and selling bonds, but it is not very well explained. We'll do this in the next class. Okay, so I will not hold you back. I have taken almost 2 minutes extra. Okay,
Excuse me,
so
sir.
yeah.
So
Attendance.
please mark me present. I joined late, yes, sir.
Yeah. So
Because
okay.
of the
So
network issue.
yeah. I'll just release everybody else, so you guys can all leave. Okay, and so anybody has a question can stay back. Now let me first. This is Shivangi, right? So I'll just take care of this. 1 minute. Just hold on. I'll let me first check if there is any question. Then I'll stop the recording. If there's no technical question, then I'll stop the recording, and then I'll take care of your attendance
Sir,
problem. So yeah.
I have
Go
a
ahead.
question.
Yeah.
So can there be a situation where policy
Yeah,
rates
one
are
sec,
not
Soumya.
near?
Sorry, one sec, Soumya. I'll just let everybody else go, just making sure. So the rest
Yes,
of you
sir.
can go. Okay, all right. The class is dismissed, and now Soumya, you go ahead. Sorry.
Yes, so I
Yeah, go
wanted to
ahead.
ask, can there be a situation where policy rates are not nearing zero and still
Yeah.
central bank goes for quantitative easing? Or is it only when policy rates are nearing zero or on that level, that's when they use quantitative easing?
Okay. Yeah. So good question. So yeah, the answer to your question is that, strictly speaking, there is nothing preventing a central bank to do from doing, because they are the ones who are in charge of monetary policy. So this quantitative easing versus a reduction in the target in the policy rate. Okay. Quantitative easing, whether to do QE or whether to do reduction in the policy rate, is a matter of choice for the central bank. Traditionally, they have done it by the policy rate, but when they saw a situation where the policy rate is like at zero, like how can we reduce this any further? So let's do QE. So that's how QE was born. Okay, so there was no QE before this. Okay, so this whole idea was born over here. The term was also born over here. So this is what. But strictly speaking, actually, in response to your question, there is nothing that prevents the central bank from doing QE. They can always increase the money supply through, instead of, because these are just tools of monetary policy. Whether you do it through the policy rate or you do it through QE, okay, is your discretion as a central bank. It's just that historically, in the recent past, the focus has been on the interest rate. So pretty much from the 1980s, starting and Paul Volcker started this tradition actually, that they sort of the money supply, they start targeting interest rates. So that's where it basically began, and that's how banks have historically operated. This is the main policy tool of choice, that is tinkering with the policy rate. Okay, which is what the Fed is doing even now today. They are still even at such a low level, they are still adjusting that a little bit. That's where the repo part will come in. Okay, but does that answer your question? So strictly speaking, nothing to prevent them from doing. These are different tools of monetary policy, and it is the discretion of the central bank as to which tool is to be applied. And strictly speaking, there is nothing preventing them from doing QE even when interest rates are positive. But it's just that historically, that is not how QE has been implemented, or that has not been the context in which QE has been implemented. Does that answer your question?
Yes, sir. And so
Okay.
also, I wanted to ask, is there any difference in which the market or the economy reacts to these tools, both of these tools, as in changes in policy rates and doing quantitative easing? As an end result, is there some disturbance? I don't know if I'm able to explain my question to you
Yeah.
properly.
Yeah. No. I understand. I think what you're asking is basically the impact, the differential impact. Is there a differential impact in terms of
Yes,
market
yes.
reaction? Okay. So one thing you can clearly see what happens. One clear difference between the sort of your targeting the policy rate. So remember, this is actually this effective federal funds rate. You can read about it here. This is actually overnight. Okay. This is the overnight rate for overnight borrowing. Okay, because these guys typically, most of the money market desks will adjust the balances on their reserve balances. They will do their planning on an overnight basis. Sometimes you may take a 14-day loan, but generally there is a very active market for overnight reserve funds. So this is an overnight basis, a very short term actually. So it's it's the shortest term possible pretty much. Okay, so this is very short term. So if you look at the yield curve, okay, the yield curve is actually quite. So you have, this is the short end of the yield curve. You understand what yield curve is, right?
Yes, sir.
Yield curve is that basically just it's a term structure of your interest rate. So if you look at the treasury yield curve, you just have over here you can find the yield curve, maybe not here, maybe you'll have here things like slope of the yield curve. So if you search for, this is a very good database actually. You guys can use it for your capstone projects. There's tremendous amount of good data, but I don't think we have a yield curve here. They don't have a yield curve chart here because actually yield curve is a kind of a cross-sectional data. Okay, so you have slope of the yield curve, but you don't have yield curve here. You can just do a check for US Treasury yield curve and you'll find it. But so basically, coming back to your question is, if we go back to this, okay. So coming back to your question, the one thing you have to understand is the difference between the policy rate. The policy rate in most countries typically focuses on the very short end of the yield curve, which means it focuses in the US. For you can see that it focuses on the overnight Fed funds rate, okay, overnight effective Fed funds. So it's a very short end of the yield curve. The policy rate is affecting interest rates at the short end of the yield curve. Whereas when you start buying bonds, okay, let's say if you buy 10-year bonds, okay, so the bonds term we use only for things which are greater than bonds and note. Bond market is greater than 1 year initial maturity. So when you start buying bonds, there's a different impact because you're impacting the longer end of the yield curve. So when you're buying bonds, you're basically, as a central bank, you're creating excess demand in the market for government bonds. So as you know, in economics, ceteris paribus, when in any market, when there is excess demand, the price will fall, right? Sorry, when you're creating excess demand, the price will rise, right? So in this case, treasury securities will rise, okay, but treasury security prices will rise, bond prices will rise, but as you know, there's an inverse relationship between bond prices and yields. In the bond market, we don't track prices, we actually track yields, the YTM. So as the bond prices increase, the bond YTMs will decline. Okay, so one of the reasons why the US Treasury 10-year notes YTMs are so low is partly because the central bank has been pretty much doing QE. In between, they came down a little bit during the Trump years. Again, they have started buying. So they've been doing pretty much, very high octane QE has been going on for most of this period. So that's one of the reasons why the central bank is long-term interest rates are low. So one clear-cut answer to your question is that you have to understand that the tinkering with the policy rate here, policy rate tinkering impacts the short end of the curve here, very short-term interest rates, okay, for very short periods like overnight. In the case of the US, we target overnight Fed funds. Now, whereas QE, because it involves buying bonds necessarily a longer term, so QE will impact the longer end of the yield curve. Notice 10-year YTM. Okay, so there itself you have a difference because longer end of the yield curve, it has a differential impact because you have a lot of home mortgage rates which get affected. Technically, when you impact the short end of the yield curve, there's no reason for home mortgage rates which are longer term rates because you take 20-30 years to pay back. Those are longer term rates. So if you are tinkering with the policy rate, you're affecting the short end of the yield curve. When you're doing QE, you are impacting much more. You're having much greater impact on the longer end of the yield curve and hardly anything on the short end of the yield curve. So that is a very important difference between the two tools. So they have a differential impact in terms of the. So in terms of a theoretical learning, you can absorb that, right? That basically I can write that down because it's an important point. Okay, which is. That we just take all this, maybe we don't need to just copy it and then I'll remove it down below. That we can write it at the end of the discussion after we have understood this, as long as it's there in the notes. Okay, the QE. Sorry, come again.
So Vaibhav says, sir, please mark me present, sir. Vaibhav Saxena.
Yeah. Just wait, because the tradition is that I want to close the video before marking people present, or I can actually note. I will note it down here, and then I'll just because we finished the record. We want to first address questions and then only address the administrative aspects. Okay. So anyway, I'll write it down for you. One is Vaibhav and one is
Devika.
Shivangi, right?
No, sir, Devika.
Okay. So that was not Shivangi. So it was Devika who spoke earlier. Okay.
Yes,
and who
sir.
Pant?
Yes, sir.
Okay, so Devika, Vaibhav, and Pant. Okay, actually, one thing. You guys please just stay around. Okay, just hold on because we need to follow that distance. In case I forget, it'll be a problem. I just want to make sure that we do this. Okay, just wait. Okay, let me answer her question and let me just write this down. Okay, that quantitative easing affects uh, the long end of the yield curve. Okay, because this much discipline we have to have because it's technically you're late. Actually, you're not entitled to attendance actually, but I'm just doing this as a favor. So you have to just follow the discipline because we don't want to clutter the video recording with the attendance and all that, right? So affects the long end of the yield curve, and okay, because we affect there's policy rate changes uh, affect the short end of the yield curve, okay, which is basically the uh, affect the short end of the yield curve, okay, the short end of the yield curve, short end of the yield curve, okay. Policy rate changes affect the short end of the yield curve. Okay, so this is an important point. Yeah. So does that answer your questions, Soumya? Do you understand
Yes.
one impact, one differential impact? So it will obviously have, then you have to start thinking about what is connected to the long end of the yield curve, like home mortgages.
Yes.
Whereas here, there's no impact on home mortgages. So through all that, there is a in the differential impact on the financial market, in the financial markets, right? Or on the financial markets. Okay, different parts of the different types of products are affected, right? Right? Is
Right.
that
So,
clear?
so as
Okay.
as tools, they cannot be used interchangeably. Then the central bank would have to look at the kind of impact they're trying to create on the market.
Yeah, so they have to apply their mind to, if I do this, then this is going to be the kind of impact, and then if I do that, it'll be some other kind of impact. Okay, which is probably why they have tended to favor the policy rate, because these long end of the yield curve, the impacts is generally a little bit harder to predict and a little bit more diverse impact. Whereas the policy rate changes, they probably feel have a narrower range of consequences. So that's why they prefer this, and only when they get stuck on this, like the rate is so low that they can't cut it anymore, and only then they use this as a second best option. Are you following? That is probably
Okay.
it.
Got
So
it. Got it.
this is actually more unpredictable in terms of exactly how it will impact different parts of the financial markets. Whereas this here is the kind of more controllable kind of a short-term rate, so less likely to impact too many factors, too many other types of transactions, etc. Right?
Okay. So yes. So got it. Thank you, sir.
Okay. All right. Done. So we'll just close the recording, and then uh, we stop recording. Stop recording.